Okay, what you're looking at here is the S&P E-mini 5-minute chart for today, May 21st. It's a Wednesday. We had a steep sell-off toward the second half of the session due to rising treasury rates. Uh, and I just want to walk you through the chart and show you what can be done when you're in a trading range environment. We've experienced a trending environment for a few years already, for past almost several years, but now we're in a trading range environment. How do you know you're in a trading range environment? You look at the daily. All right, where are we with respect to the daily chart? And we're really no further off than we were back in February, March. And yes, we had a steep sell-off that's a breakout of a trading range, then we went back up. Doesn't feel like a trading range because it's just very volatile, but it's still a trading range. It's not a trending environment here. Not a bearish environment, although the you know or I should say it's not a trending bearish environment because the sell-offs eventually lead to a bounce up, and we don't really have a confirmed trend in either direction at this point. Anyway, I'm gonna walk you through this. So I marked off the overnight highs and lows over here as resistance points. As resistance points. We have an indicator that I've built. I've only built this just recently. We'll be integrating it into the automated algorithm that's gonna make its debut soon. But I built a trap indicator over here. Over here we have another indicator that I borrowed from TradingView that shows false breakouts. And this shaded region is a chop zone region. So what does that mean? A chop zone means you have a lot of overlapping bars happening. You have a choppy environment. And when you're in the choppy environment and your mindset is that of a trend trader, well, that's a formula for you to lose a lot of money very quickly when the market's not even doing much. So, and at the bottom over here, we just have the average bar range, which you could use the ATR, the average true range. It doesn't really matter that much, but it gives you a sense for what your target profits are going to be and what your stop should be, or how wide your stop should be. So we start off the day like this. After I mark off the overnight highs and lows, I just go back to regular trading hours and just adjust this over here. Okay, so you see over here, we gap down. Whether we gap down hard or we did not really is relative to the prior days. It's not universal in nature. So you could have something that looks like a huge gap down and it could just be like a regular gap down. So, but anyway, we gap down over here and we started going up. You see, you have what's the start of a leg over here. Over here you have the EMA, and I'm starting the day in trading range mode, right? Because I see you do have some overlap. You do have the indicator is calling for a choppy environment. There's no indication that it is a trend, and we did gap down, right? And we're trying to fill this gap. So one of the first things we see, and I see this as a second entry short, but I'm not taking second entry shorts because this is a trading range environment. I don't see that as a quality trade to take. We do have a trap over here, a little bit early in the day for me. The algorithm trades after 10 o'clock, and that's because, or 10 o'clock Eastern, rather. And that's because you want the volatility to settle down just a little bit. You get too much confusion in the markets, too much hype, and you really want to wait until a good half hour to go into your trades. So I skipped this one. I'm not a big fan of second entries when it comes to trading entry or trading ranges because it's just, you need a lot more context to do that. So I'm looking out for failed breakouts. Why am I doing that? because that's a good setup. Most breakouts fail. There's an 80% chance that the first breakout of a trading range will fail and bounce back up. Now, a lot of the books tell you, oh, it just broke out of a trading range. You got to sell. You got to sell. And all these trading books out there, there are a gazillion of them. They're going to tell you that, and it's going to work 20% of the time. All right. So when you do that and you sell, you're selling to a guy like me. I'm buying it, and I thank you for the cash, and I just take the elevator ride all the way up here. Next, we have a bull leg over here, and when I see a bull leg, I start getting into. I'm still in trading range mode. I'm still looking for false breakouts. All right, but here's the thing about bull legs. You have to consider that it's more of a trend trading range. So what do I mean by that? I mean it's a trading range, but you want to take the side of the direction of that leg, right? When it's early on, okay. Reason being is if you take the other side, it makes for a lower quality trade. It doesn't make for a bad trade, but it makes for a lower quality trade. So you come in a little bit too early. You're just taking on a little bit too much risk if you're taking the other side. That's not to say it won't happen, but you have the EMA over here, which acts as a support level. And if you start selling over here, you're selling. You're selling in a stronger environment. So you have two traps over here and a false breakout. In this case, it's justified to take a trap for a small scalp. You have a first breakout over here followed by a trap, so I took that, and you're going in here, but you have to understand it's all about context. All right, so when you have a trap happening, when you're going up against the Globex resistance, when you're going up against a gap that's more or less filled, there's really no more room to go if there's any room at all. All right. And it has a breakout. You want to weigh all those factors in and make a decision based on a scoring method, but based on the totality of everything, that it's worthwhile to take. All right. Under different circumstances, this would not be a viable entry to go into. Right. It wouldn't be a good setup. So over here, took this trap over here, and then I'm sitting, I'm waiting. Now let's do a count. Let's say the trading range started. How do you know when the trading range starts? You have big up, big down, then you have big confusion. So you could mark this as a start of a trading range. You don't have to be that precise, but when a trading range will be tested from both sides is usually about 20 bars in. All right, at the start of 20 bars in. So 20 bars is about 100 minutes. You want to give it until about, on this one, it's 11:20. So you want to give it about, until about 1 o'clock or so. All right, about 20 bars in. And you have over here another breakout, right? Most breakouts fail. This, I would say, is sort of a medium risk entry. Again, it depends on the context. What you have going for you is the Globex resistance, right? You don't have any follow through with the Globex, but you also don't have too much of a risk reward happening here because you're kind of caught in between the EMA and the Globex resistance. It's a decent setup, but it's a very small scalp. All right, but it's a trading range. Over here, now, as you're heading into the 1 o'clock session, let me just see how many bars are here. All right, we're approaching the 20 bar mark. The 20 bar mark is actually over here, and that's where sellers step up and they test the boundaries of the trading range. So you're coming in right before the 20 bar mark. You see a trap over here. It's in a transitionary period between trading ranges. So when you have the shaded period over here, that's a chop zone. This transitionary period, that's another zone. So you have a trap happening over here. and you have no follow through through the Globex high, which is a great sign. So you sell over here into the EMA. That is approximately that's approximately 7 points per contract, and you close the position. Now what do? You're on your 20th bar. You just had a close. You have this big juicy bar that's bigger than many bars before it. You see this bar? It's small, it's tiny. This one's more of a medium bar. This is small, small, small. So you have a really thick bar uh, with virtually no tails to it. That's a big sell bar, and that is an indication that we're heading a lot lower. All right. Now, just yes, we are heading lower. Okay. High probability now that we're heading lower. Whether it's about the news or not about the news, it doesn't matter. We have a big sell bar with a shaved tail. This is breaking out. Now, let's give some thought as to if this is breaking out, where's your stop going to be? Well, your stop could be over here, or your stop could be somewhere a little bit higher from the previous day over here. All right. Probably it'll be more of the Globex session, because if this turns out to be a false breakout, you're closing your position and going back up, because then we're breaking out higher. But in any case, when you have a breakout of a trading range, what's going to happen is you're going to get a measured move. So a measured move means it's going to, you can expect it to go the distance of this trading range. All right. So it's going to go, how many points is that? 44 to 55. So you could expect it to go at least 11 points higher. Or, I'm sorry, at least 11 points lower. That would put you at 35, somewhere over here. Now what do you have? Well, you have another trading range. All right. So you have two trading ranges stacked one above each other. What oftentimes happens is when you have that and you have a breakout of a trading range with follow through, you're going to get a larger measured move. All right. So if we go over here and project, do a Fibonacci projection, we're going to see that this trading range, all right, the measured move of both of these trading ranges stacked together are going to be somewhere over here. So, and this was, if you're selling in this kind of environment, you're selling at this bar over here. You have a little bit of a retracement into the EMA, but no follow through. So that's a great sign. You're selling even more. All right. And now you're facing some resistance in the zone, but that was the answer to that question was quickly and swiftly answered with this huge bar over here. So when you have a huge bar like this, you can expect that we're breaking all the way through and we're getting our measured move. Now, where's the measured move? It would be basically be the entire range for that day. All right. So we're going to have a measured move for the entire range of that day. That puts us somewhere over here. That's where all the sellers are leaving. I'm just going to move this over. Now, so all the sellers are here. Over here, you have a trap. Now, what happens when you have a trap? Well, consider buying into it. Now, with a sell-off like this, with it being in the afternoon session, let me just see if there's any other support anywhere else. There seems to be support on the prior day and the prior level. Let me just see what this is. this seems to be another support zone, but in any case, the measured move was achieved. Are you going to get another measured move now? Okay. For you to get another measured move, you would need, you would at least need um, another retracement up. Okay. You would at least need to test for another retracement, then move lower. And oftentimes, what you have when you have a big sell like this is it evolves into another trading range environment, and then the market decides what direction to take. Now, suppose you kept on selling and you decided to sell into this low over here. You're at the very low, and this is your first green bar. All right. How are you feeling about that? A little bit iffy. On the one hand, it could resume its down selling. On the other hand, it'll go into a trading range. It going into this V reversal pattern, this sharp V reversal pattern, it's about a 10% chance of that happening. So unlikely that that's going to happen. So if you're trapped, it's not the end of the world. It just has to be managed. So the trap traders over here that sold into this, theoretically, they, I'm sorry, that sold into this. Theoretically, they're also going to be selling into the next bar over here at the very high. And now they're scaling in, and that's their average, and they were allowed to get out. All right. So, and those that recognize this as a false breakout took a quick scalp, bought into it. Now, what happens afterwards? What happens afterwards is we again go into a trading range. All right. We keep going into this trading range environment. Everyone that sold is getting out. All right. You know, they're getting out at different price levels, but the bulk of the money has already been made in this sell-off. And if you keep going further, you're going to see that we have another breakout, another false breakout. It failed to go down, right, and went up. Okay. This is actually would be, let me just remove this Fibonacci here. So you could see it better. All right, this actually would not have resulted in a profit had you bought into this this breakout. But even if you did buy into this breakout, let's see if you could save yourself. If you decide that you're going to be buying into this breakout, all right, you might want to scale in a little lower at the next bar. All right, your average would be this, and you would get out of this bar. This green bar over here is not a coincidence. All right, it's the result of, it really is the result of trap traders scaling in, trying to make the best of it, and now they're selling off, and they're selling off over here. All right, and you have a wedging environment now, because right now you see you have a push down over here, another one, another one, another one. Finally, it starts reversing, testing the EMA. All right, but this zone over here allows for trap traders to get out. You didn't have a lot of momentum going to make it go any lower, since it's already got its measured move, and the market went sideways again. Okay, finally, toward the end of the day, it tested the EMA, sold off over here, and that's how we closed the session. But what I found really interesting over here is not so much the sell-off, because this happens often enough. What I find over here is the dynamic in the trading range environment. So here you are starting the day wondering, how am I going to trade the structure? Are we finally going to get a trending environment, which happens typically over the course of several years? It averages typically once per week. Or are we back in the trading range environment? And if you're back in the trading range environment, what's the game plan? The game plan is going to be to fade the breakouts, fade the first breakout, because that's the highest probability of success you're going to have. It's an 80% chance of success here. So you're looking for patiently waiting for these false breakouts. The first false breakout that you have was over here. As you could see, yeah, I could see some people saying, okay, the first bar is actually the very low, but we have to look at the trading range. What is the actual trading range here? The trading range over here, it really starts in this area, right? It really starts on this zone over here, and you had a false breakout, and it didn't take, okay? And plus you have support over here, right? And plus there's a psychology of having to fill a gap. So many traders decided to fade this breakout. Then the question is it going to follow through with the EMA? Okay. So you could set a profit target around the EMA over here. Let me just increase this. Close the trade. Get back in here on this shaved bar, because this is pretty solid evidence that you're going to have a continuation to the upside and probably even fill the gap. You have a shaved bar over here. This over here is what Ali Mo Afshari calls big, small, big. All right. So big, small, big would imply that you're going to have a continuation to the upside. This would have happened but for these resistance levels and this gap. So the trend didn't resume. It stalled. And if it didn't resume, it went back into this trading range environment. That's why we have two trading ranges stacked upon each other. And here's now the interesting part. If you're not, here's what you need to determine. What kind of a trading range are you in? Are you in the trend trading range, or are you in an actual trading range? Because in the trend trading range, you're just looking to buy. You're looking to sort of buy over here. If you're very far away from the EMA and very close to resistance, maybe you want to sell over here. Maybe you want to sell over here. Definitely want to sell over here, because the longer the trading range lasts, the more willing sellers are to step in and test the breakout to the lows. If it started as a trend trading range upward, the more willing buyers are willing to step up and break out the trading range if it's a trend trading range downward. So there are 20 bars have passed, the sellers stepped in, tested these lows, and the test succeeded, right? They closed their positions, got back in, rode this for a measured move. Some decided, okay, it'll be a measured move over here. You see a little bit of hesitation at this tail over here. But overall, there looks to be a consensus that we're heading into a measured move at this point over here at 1. And this is the bottom, okay? You also had a little bit of hesitation because we were hitting the overnight lows. So some traders closed their position or took some positions off just as a matter of risk management. Others rode it all the way down here. But the overall thinking was that we can test the trading range after about 20 bars. Give it about 20 bars, see where it goes, because it's either going to resume up in less than 20 bars, or we could test the breakout and ride this wave over here. The momentum itself, you don't really catch it. You don't really foresee it until you have these big shaved bars over here. So let me just increase this. Shave bar over here, very high probability that it's going to go lower. It's got little to no support. Okay, retracement over here, but notice that there's no follow through to the EMA. The EMA is serving as a resistance point, giving sellers more confidence that they could sell. If they close their positions, they're jumping back in. You have a big bar over here, a little bit of retracement here, huge bars going all the way down. Finally, you have this big outside bar. One thing that matters about big outside bars is they are not contextual. All right, it's a non-contextual bar. It could go either way, but high probability right now, when you see a bar like this after this kind of a sell-off, after a measured move, that the sell-off has stalled at a minimum, and we're going into a trading range, and then it's a question of how you're managing your positions. So I hope this sheds some clarity on it. If anyone has any questions or would like to discuss this chart, I'm open to it. But I found this day fairly interesting because I was actually looking for a way to better articulate an algo to work in a trading range environment where you're fading the breakout. And it's not enough just to say, okay, well, it broke out for the first time, 80% chance that it's going to fail. There needs to be a lot more context. Okay, so the algo itself is driven based on principles, based on first principles. That's the foundation for it. And it takes a look at a lot of contextual factors, as many as could be determined matter when it comes to this. Gaps being one of them, resistance points, VWAP is another factor, the EMA, lots and lots of factors to determine, okay, you know, do we take on this entry? All right. And over here, this indicator, which I'm hopeful it'll be integrated in, will answer the question of, you know, do we trade trading ranges in this kind of fashion? All right, is this enough? So the backtests will reveal themselves in due time, and we'll see if we can go forward from there. All right, and that's pretty much it. And let me know if you have any questions.